Hello. I was just trying to call you.
Can you hear me?
I can hear you.
Hey?
What? Did you go buy a new computer?
No.
You
I
actually fixed it.
I hit the microphone button and I pounded the M word, which it said, and I hit it about 24 times and it turned on. Don't ask me. Don't ask me.
Hey,
It just worked. So you
per-
can you hear me fine?
yeah, you sound great.
Okay.
All good.
I
Hey,
don't know
what?
how to turn said microphone up, so I'm just gonna leave it.
Yeah, no, you're perfect. What is your mobile number?
778
Oh, okay. Hang on.
877
Yep. I got that. 778-877-1198.
1198. Yeah.
That's mobile. What is 604-340-6205?
Cancel that.
Gone. 604-232-5413.
Cancel that.
Gone. There we go. That's so weird. Why did they not go away? Mobile.
I'm just gonna grab my coffee for a quick sec, bud.
Yeah, I'm gonna take us out of the studio. Well, there you are. Oh, that coffee actually does look pretty good. Oh no, your mic isn't working now. Oh no, what did you do?
How does it work?
No. Wait, there you go. Nope.
You can't hear me?
Now I can. Oh, wait a minute. It's a big delay. No,
Yeah?
now I can't hear you. Wait, now I can.
I didn't do anything.
Oh, it's a super
Yes or no?
delay. Yes.
Um,
It was on a delay or
Okay.
something. Catching up.
Muted?
No, I think
Oh.
you're.
You
I
want me
think
to,
maybe
you
you're.
want me to go in and out again?
No, you're good now. Now it seems to have caught up.
Okay. I
Um,
don't think I need
but
my
that coffee
glasses.
does.
I probably do need my glasses.
Do you use your glasses just for the computer?
Just to read some of your, yeah, I just use it for reading and computer.
All right, I'm gonna go make a quick coffee.
Especially some of Kuda's charts. You need glasses, man.
You know what? I might have you go out and come back in because there is a delay, and
Yeah.
I'm actually hearing my echo. So do that.
Okay, here. I'll do it.
All right. All right. Let's see how you are now.
How's it working?
Now it's good. Yes. Much better. You were a little grainy in your picture before as well.
Okay.
Do you ever do the internet speed test on your computer there to see what kind of?
You must be kidding.
So, we're in.
I don't know how to do any of that stuff.
You just go to it's a web browser thing. So the internet here in the Board of Trade is really fast. It's fast up and down. So here I'm going to run my test. I'm at, call it 700 megabits download. So that's almost a gig. Oh, wait a minute. My upload's slowed down. What's up with that?
Is mine normal?
Yeah, you're looking good now. We
I've got like full bars and everything. It's looking,
Are you
I
out
don't
on the
know.
island?
No, if I was on the island, you might get, that's a little different. If I was on the island, you'd be seeing logs behind me.
They logged that island?
They did once,
Oh,
and
logged.
it's all like in 1920. It's all growing back, and we've got, I don't know, on our property, we probably have 1,000 trees,
Oh,
probably.
wow.
Yeah, all like almost too many. We need to thin it out a little bit.
Yeah, I was checking out the other day on Google Maps. I love Google Maps. Um, all the inlets and everything out there.
Oh yeah,
Um,
no, there's a lot of islands and a lot of trees out here.
do you have a boat out there?
Yeah, yeah, I got a Grady White sort of center console
Yeah.
fishing, fishing boat.
It's amazing you don't need that big of a vessel out there. I mean, it's pretty calm, right?
No, but you're kind of protected by Vancouver Island, right?
Yeah.
I mean, Vancouver Island's massive, so it stops, any of the bad stuff. If you want to go out there, you know, it's kind of like off North Carolina, right? That's where Grady Whites were invented. If you want to go 20 miles out, you might want a bigger boat.
Um, there you are. Got it. So, what if you went across the Strait of Georgia? How
Yeah,
would
I
that?
do. I do that. I do that all the time. That's easy. It's, I don't know, 14 miles.
Okay.
But again, it's protected, right?
Yeah.
From the Pacific. If you want to go through the Strait of Juan de Fuca and around and up, you got to be paying attention. That's a little different. That's the open Pacific.
Yeah. What have you ever gone way up by like Campbell River,
Good.
Manson's?
Yeah. Yeah, as long as you're on the inside, you're fine. It's around the outside, to the west, like fishing boats sink out there.
Yeah.
It's serious stuff.
Um, it's so cool up in there. That's some pretty remote stuff up there, huh?
It's beautiful. It's absolutely beautiful.
So, if you were going to go fishing out there, do you troll or how do you fish?
Yeah, you troll with downriggers. Um, if you want to go for halibut, then you jig. Um, but yeah, you generally troll with downriggers, and you get it. I mean, you get it down there anywhere from 75 feet to 150 feet.
How deep
And
is
you
it?
got you got fish finders on your boat, so you can kind of see where they're at,
Yeah.
and then you just drop it down with your downrigger. And you got big steel ball, and it just takes it straight down.
Um, Now, is the water when you get up into some of those inlets, does it become brackish?
No, it's just really flipping cold. I mean, cold.
Yes. Um,
Yeah, no swimming up there.
what about around your island?
Oh, yeah, usually on almost all the Gulf and San Juan Islands, which is the same chain, just one's in the U.S. and one's in Canada.
Yep.
The eastern side is the warmer side, and the western side is the colder side.
Yeah.
Don't ask me why, but it's almost guaranteed.
There's Greg Kuda.
What's up, boys? How are you?
Hello. Doing well. I'm learning about the waterways and the water around Vancouver and Kipps Island.
Yeah. No, it sounds like an awesome area.
It is indeed. All
Pretty
right. Well,
nice.
why don't? We're 12:01. I believe the email went out, so let's kick this thing off here. February 7th. I couldn't believe that. I looked down today, and it was February 7th.
Time flies when you're having fun. So this is a pretty big slide deck, but part of it is I'm presenting. Alex and I are presenting in Denver later this week, so I just borrowed a huge chunk of my slide deck, so we don't have to reference everything. But there's a lot of stuff here.
Okay, let's see what you got.
So I think the big thing that stands out, just starting more broad based and then working down into lumber. January was a good month for equities, and here are the different sector performances, and the one that we want to see here, especially if you're in housing, is look at home building. So since you could say the lows back in October of 2022 through February 3rd, home building has had a rebound to 42.6% off the lows. Building products are up 29.7%. You can make the argument you got too low, but I mean it's still positive growth. That's a good sign in that we're no longer at the bottom of the barrel, and kind of as markets were leading the charge down. The energy sector was up here, and you've kind of relegated energy now to the bottom of the barrel, in that you could see energy's only up 7%. Oil and gas exploration is down 7%. So it's just kind of interesting to see, since we've officially bottomed in October, it's good to see how home building and building materials up at the top of this list.
Yeah, and real estate is up there, up 20%. It's on the lower side of the left-hand column.
Yeah, and so apparently it's also good to be a good. It's also to be a good footwear manufacturer, and then casinos and gambling. That was my favorite. That's the people apparently have comfort to gamble. So.
Well, they can't gamble on Bitcoin because that's not as volatile.
Right. And so then the one thing, equities continuously seem to be calling out the Fed here, that they don't believe that the Fed is going to adhere to what the Fed is actually saying. And you can see kind of to start the year, this is basically a put call ratio. To start the year, markets were extremely bearish, and as you progressed through January and you had appreciation in equities, you could see how this has dropped from, at one point it was at 2.4%, now it's sub 1%. It's down to February 3rd, 0.57%. So the market's,
this is the number of puts compared to the number of calls.
Yeah. So the market's less bearish now than it was to start the year.
At its peak,
and you see this with VIX too. Yeah.
So at the peak, there were, for every call, there were 2.4 puts.
Exactly.
And a put, of course, being option to sell.
Yeah. So the higher we go, there's less bearishness, which is you would think just the opposite, but everybody likes a good feel-good story and to trade the momentum. So just the opposite now. And so kind of, I won't dwell on this too much, but you can see how PE ratios, again, as you got into the end of last year, here's October, here's December, kind of multiples were dragged down. Now all of a sudden the glass is half full again. We're going to soft land, blah, blah, blah. And you're starting to see PE forecasts starting to moderate back to the upside, where, again, maybe we can soft land and life isn't that bad.
And PE, of course, price to earnings ratio. It's
correct.
Kind of basically a measure of future, what the stock traders are willing to pay for the earnings that they currently have.
Yeah, exactly. And I know kind of Kip and I talked about this a little bit yesterday. And Mike, I think we might have mentioned this, but you've had a big, so the U.S. dollar index, and again, the dollar is just an index of other foreign commodities, but it just gives us relative strength of the U.S. dollar in comparison to other foreign currencies. And so you've had this big reversal over the last 4 days, where you've gone from around $1 back up to the 103 70 area, and we're back in the 103 area. Powell just spoke and drove equities higher and the dollar lower here, literally in the last 10 minutes.
Yeah, that was quite a 50 handle rally.
Yeah. He said the period of deflationary, the deflationary period has begun, but we still have a lot of work to do. So again, talking out of, I guess like we do, talking out of both sides of our mouths.
Maybe we'll be asked to be Fed governor someday.
Yeah, exactly. But like the reason I think that this is important, we've kind of bottomed in the dollar, and where you see this being relevant is as the dollar. So it's a lot easier for commodities to rally on a weakening dollar structure. As the dollar weakens, commodities are denominated in US dollars, so it's a lot easier for them to appreciate. As the dollar strengthens, you have the inverse, and you can kind of see how we've seen copper, gold, the energy markets, wheat, and lumber kind of slow down. So I think where this is relevant, we've talked about the commodity funds all along, kind of covering their shorts. And a big part of that was they were buying everything else under the sun in January. They were going long energy markets. They were going long the ag, grain markets. They were going long precious metals. They were going long industrial metals like copper. Well, they stopped, in the last 10 to 7 days, they've collectively stopped buying commodities. Now, crude looks like it's trying to bottom here, put in a buy signal yesterday. But, part of kind of lumber kind of taking a hiatus here is, yeah, we kind of ran out of curtailment news. But the other part of this is the commodity fund shorts. You probably reached that threshold where they ran out of stuff to cover. And then more importantly, commodity fund longs stop chasing this market higher. And part of that is, well, this is all interconnected. And if they're not buying these other commodities, chances are they're going to stop buying lumber too. So it's just something to watch. And then you see, and literally in the last 5 days, you're looking at all the winners out of 50 some commodities. This is it. Orange juice for all you big orange juice traders out there. VIX has been a little bit better just because of the Fed announcement last week. You see NASDAQ, you see kind of the other equity markets, but the one that stands out, US dollar, is up just under 2% in the last 5 days. And then you look at kind of the inverse of that strengthening US dollar, euro, Brazil real, Australian dollar, British pound, New Zealand, commodities, gold, crude oil. Here's our lumber, silver, RBOB, aluminum, copper. As the dollar has strengthened, lumber's not the only market to see weakness. You've seen it in the other foreign currencies. You've seen it in commodities as a whole here. Here's your Goldman Sachs commodity index. So it's just something to watch, that if the dollar, and when we go back to dollar strength here, 50, 62% retracement, you could get back to a 105, 107, 110 area. That's likely to keep other physical commodities under pressure, and that could influence lumber. As far as we know, that commodity fund shorts got annihilated here. Commodity fund longs have come into the long side of lumber. So this is something to watch as far as how they would trade the long side of lumber. If they're going to get beaten out of these other commodities, then what's so special about lumber? So just something that I know Kip's watching. I know you guys watch. I'm certainly watching as well, that dollar strength there.
Well, so much of our wood in the United States comes from offshore or outside the country. A strong dollar is a bigger return. It's pretty simple math.
And so the other byproduct of last week was obviously Fed raised a quarter of a basis. It's what he didn't say or what the market interpreted. And right now, equity markets want to interpret anything that comes out of the Fed's mouth, Powell's mouth, as bullish. We beat inflation. And so, obviously, we're getting one step closer to Fed fund terminal rate, which is around 5.25. You're up to 4.75% now. So ideally, in the next 2 months, you could be at that Fed Fed fund, and you can see we're leading Bank of England. We're leading all other countries as far as the race to the top here to get the Fed funds rate. And the reason I bring this up is when we look at 10-year notes, there's been a pretty big change in 10 years. So February 2nd, we were sub 3.4. You actually, the low water mark, you got down to 3.35. You were back up to 3.64% as of this morning. And when you look at 30-year mortgage rates, I know the headline last week is that we had touched sub 6%. We were like 5.99%. That was the first time since I think September or October that we were below 6%. And you can see, again, $300,000, 20% down, decent credit score here. You're already, and these are your low water mark, your FHA and VA loans. You're already back up to 6.4, 6.5%. 30-year fixed, you're starting to float back up, but well above 6.5%. So very fleeting to be at this low water mark of 6%. You're starting to trend back in the wrong direction as far as home building is concerned. And again, I'll come back to that one. The reason this is important, and Mike, we've looked at this before, but the difference between a 3% and 7% mortgage payment, is pretty staggering. So here's your 6.42 versus 5.22. All this starts to add up as far as availability, who can buy, who can qualify, who can afford a home. And obviously for home building, we want to see stuff trend sub 6%. You want to get back into that 5.5, sub 5.5% mortgage area to really kind of re-engage the single family component of housing.
Yeah, I mean, $1,000 difference between your mortgage payment from 3.22 to 7%. That's pretty stout.
Yeah, I mean, you can see, it's staggering where, 34% of households versus 20%. That's a big difference, a number of starts on an annualized basis. And so then the other thing, Fed funds rate versus mortgage rates. You can see how the Fed fund rate is ticking up here. Mortgage rates, like convergence here doesn't make a lot of sense. In that if we're gonna, what the market is trying to forecast for the Fed is that you're going to reach terminal Fed funds rate of 5.25, 5.5%, but the market's forecasting by the end of the year you're going to have rate cuts, not rate hikes, but not only are you not going to stay at these levels that they're forecasting, by the end of the year you're going to start to see this come off to kind of separate these two. But one of these is going to call the other one out, and if rates are going to stay longer higher, then the idea that the 30-year mortgage or 10-year, 30-year mortgage rates, 30-year treasury rates, 10-year rates, it's you need to see the Fed pivot on their interest rate model to support kind of, the premise for a positive housing in 2023 is really twofold. It's that we're going to soft land economically. You're going to have a very shallow recession. Maybe you don't even have a recession at all. And you get moderation in interest rates where you get interest rates sub 6%, sub 5.5%. That's how you organically grow housing and shift away from multi back to single family. And so, those are two, in my opinion, those are two big what if hurdles. I'd love to believe that, but I really want to see the metrics to suggest that that's real. And I think, the big unknown is going to be interest rates and how serious the Fed is and what they're telling people.
I look at that and I see the mortgage rates peaked right when the equity markets bottomed.
Yeah. Yep.
Well, and one other thing, that's I guess you could call it a green shoot, is right now the credit spread is 270 basis points between the 10-year and the 30-year fix. Normally, that is closer to 160. So there's a potential that if they signal they're not going to increase, I mean, that's basically a 1%, right?
Yep.
There's a potential that number starts to close closer to normalized and that could get you into the 5 spot. But that's not gonna happen until I believe they have to say they're not going up anymore. That would be at least the signal to start that conversation. In the meantime, we're paying literally 100 basis points more than in a normal market.
Yeah, no, that's a great point, Kim. That's a great point. And so again, I don't want to. Again, I got a million things in here, but part of it is we could skip over. But here's kind of the biggest. We hear about CPI, PPI, but this is the Fed's favorite inflationary tool. Personal consumption expenditure deflator. So this is what the Fed really looks at to measure where they truly believe inflation is. And again, I don't like this one. Expenditures. This is X housing, and I don't know how you just separate housing, whether you own a home or rent a home. That's like again, looking at inflation without food or energy. Things that people have to consume. They're not luxuries; they're necessities. People have to live somewhere. People have to eat. They have to use energy to power cars, to travel, all that good stuff. But this is kind of what the Fed wants to see. You want to see this moderate back to your sub 3%, your 2.5%. So this is what the Fed's watching closely. I think more closely than anything else right now from an inflationary standpoint. They want to see this back at 2.5%. And not only do they want to see it back at 2.5%, they want to see consecutive quarters at 2.5% to say that we did it. That's kind of, you're in a deflationary mindset, but they want to see consecutive quarters of data to say that, yeah, we did it. We annihilated inflation. Kind of skip over this. Obviously jobs are still record highs. GDP growth, we could skip over this. So the one thing here, and we'll kind of jump into housing. Here's GDP growth from housing, and here's your residential fixed investment. You can see the single family component of GDP or lack thereof. Here's your one growth metric, the multifamily. So again, from a GDP standpoint, all the growth is coming from multifamily. Yeah, I'm just looking at Brad's commentary, and I think a big, can you still be profitable in building a smaller house with the land labor cost? I mean, have land costs come down to justify building a smaller footprint? And the answer is, if you want to grow single family, I think that's going to be a necessary component of doing it.
Well, and they can just renegotiate their land moving forward as well.
Yeah, absolutely. And I think I've got, we can come back. This isn't, let me see here. So again, newly constructed home sales down 16% in 2022, lowest level since 2018. Here's your annual existing homes, lowest level since 2014. So newly constructed home price versus existing home price. So this is the issue we have, is that here's your 2018 levels. Here, even though we're starting to trend down on cost, you're still not back to 2018 levels. And I've got another slide here that shows from the peak in 2022, home prices are still up 37%. So you've got to incentivize, home builders have to incentivize. They need to cut their profit margins and incentivize people to buy homes. You need interest rates to come down, and you need home prices to fall. I think these are the obvious things that are going to grow housing moving forward here. Let's see here. We can jump into. I thought this was interesting too. If you're looking for, and then we can jump into lumber, guys. But these are your. And I hate to get political, but it's pretty funny to look at this and not get political as far as states losing. And again, this isn't kind of illegal migration or this is just migratory patterns where these are your states losing population, these are your states gaining population. So if I'm a home builder and I'm looking at organic housing growth, I kind of want to look at these blue states going forward. This is where your growth potential is. Florida, Texas, the Carolinas, Georgia, Arizona. I mean, these are obviously going to be the areas that continue to lead the charge to the upside. So let's get into lumber.
All right, lumber.
Here's our weekly continuation, kind of bumped up against the Bollinger Band high in March. And now we've officially given technical reversals. We gave late last week and then one again yesterday. So, this is a March daily chart. And guys, please chime in. We definitely had a reversal lower. And now we're starting to see retracement. And the thing that's kind of obvious to me is, the $100 basis that had existed between cash and futures, with futures leading the charge to the upside. If you believe in print and the validity of print, March right now has gotten down to 75.30. I think Fraser this morning was 470 out of the South. They were 464, somewhere in that 464-ish type area. So, one could make the case with the pullback in March futures here that I'm not going to say you've seen perfect convergence, but you're no longer at that $80 to $100 premium in futures over cash. You've definitely had the convergence with this pullback. And I know, Kip and I talked about this, that as you pull back here, it's going to be very interesting to see with some of the, with that 50, 60, 80, $100 basis opportunity, how many people come out of their short futures position and try to dump the cash. So I think without another curtailment announcement here, you're likely to see a two-tiered market develop pretty quickly as secondary traders unwind their short futures and try to dump the cash.
I'm going to share my screen real quick. Just show you something I'm looking at. Oh, shoot. I hit the wrong button. All right, so here we're on barchart.com. When we started accelerating to the upside, we left some gaps behind. Lumber is notorious for going back and filling gaps, which we filled these gaps here already. I'm looking at this gap right back here. The other thing from a technical standpoint is old highs generally become support. So I look at this level of, right around 440 to be a support level. And then when I throw a Fibonacci retracement on this, lo and behold, right here, 50% comes right back to that old high. So it wouldn't surprise me to see us come back to this 440 level. And actually fail. I could see us fail filling this gap in. It just seems like there's too many things in front of that. But 440 is not far off. What are we trading? 479, 480 right now. $40 move lower takes us right back here.
Yeah, and I think I don't know what your pulse is on cash, but cash seems to have stalled out for the time being, where mills, ask prices are seemingly astronomically high versus, how much volume is actually traded on a Western SPF basis above 420 at the mill level. Obviously I think the mills are going to dig their heels in, line in the sand. I don't see print coming off really anytime soon. So, it wouldn't surprise me if futures, believe it or not, could trade at a discount to where print is. As you begin to pull back, and then, we'll see how much of this rally really was demand driven versus supply constraint driven, where I'm a believer, and I know Kip, you guys talked about this last week. Keep the curtailments coming, and it's probably more unrealistic as we've reset at these higher cash numbers to see curtailments come out of Eastern Canada or Alberta or anywhere else. You're more likely going to continue to see the permanent shutdowns come out of BC. And if the mills like these numbers or want to take this market higher, you probably need more permanent curtailment news.
I can tell you that the European importers have loved this rally because they had some ports full of wood. We're shipping wood out of Cape Canaveral and having a hard time getting trucks loaded because there's 100 trucks in line to move the wood out. So that
the Europeans, it's kind of like I say it's like J grade. Once your mill runs the J grade, it's going to Japan. There's no other market. There's no one that'll pay that price. The European mills generally make metric, and they don't build with 2x4s. It's not really their market. So when they decide they like the price, they're going to run the logs into 2x4, 2x6. It's coming here no matter what. They book the rail cars, they book the ships, they book the time at the ports. So regardless of the price, it's coming, and it's coming right now. And they don't pay duty. Their shipment rates are down by 80%. And these numbers right now, compared to the economy in Europe, they work. So it's going to keep coming. And I talked to one guy in Texas, and he said he normally buys Eurowood and kind of puts it in his better pile with his Carrier, his Dunkley, his Square Edge, etc. He said now he's competing with the Euro with his West Fraser tubular, and he's losing orders. And so, I think that is going to continue to come. And I agree with your analysis on the board. I think we do need to go back down and test maybe a discount. And we've had probably a little bit too much excitement over the Canfor curtailments, that it's not really quite what the headline number is. It's quite a bit less, and it's still gonna ship till April. So nothing out of Canfor has changed until the end of April. And then the other thing is we just had a very strange thing in the futures market where the commodity funds took a huge short position and covered the whole thing. And I think the next time the commitment of traders comes out, they're going to be gone. Well, once that's done, who's buying lumber at $500 or $480 when cash is going to be, it's definitely going to be sub 460. It already is today with the basis trading. I mean, we've all traded lumber. When you have $100 basis, that turns into a $50 profit in about 4 days. You just take the profit.
Yep.
Yeah, and
so I think that's coming right now.
So here's the basis on January 17th. March, you were at that $80 threshold, and then fast forward, and this was as of yesterday's close, but you've narrowed that now to $26.70. So again, I just want to reiterate from a basis standpoint, I know there's lots of variables, moving parts, but you're not trying to capture 100% of that basis opportunity. If you can capture a percent that you deem, like this is good enough, then you're moving on. And I think with some of the big kind of wholesale brokerage, wholesale transient groups that typically basis trading isn't necessarily their obvious model, I do think that there's going to be a lot of basis wood that gets unwound. And then you're going to see in certain markets, the usual suspects just come in and dump that cash. And yeah, it doesn't matter what the local market is. We got out of the futures. Again, the true definition of a basis trade is that you liquidate both sides of the futures in cash, staying in one or the other, that's speculation. And if you're a true basis trader, when you liquidate one side, doesn't matter what side you liquidate first, you'd have a tendency to come in and liquidate the other side. So that's where I still think you're going to see, if I'm telling people to look at buying cash right now, it's not at the sawmill level. It's going to be at the secondary wholesale level, because as they unwind their futures, you're going to see those lists get bigger and bigger. You're going to see more lists at the secondary level flood the market. And for those kind of the end user segment, the retail side of it, I think you're likely going to get better deals in the secondary market than you will at the sawmill level. The sawmills, again, I think are going to dig their heels in and just try to wait this out.
Well, and then it's in their best interest to keep print prices as high as possible for their contract business.
Yeah, absolutely. And so here's May. 2 weeks ago, we were $84 into $41. And obviously, this is a little bit more narrower today. And again, this is based upon print. We can't speculate on what the real cash market is. When we look at the basis calculations, we're just going off of Thursday night prints. And so, again, kind of detailing open interest. Here's your open interest back on the 27th. Legacy futures up at 23.54. The mini up at 598. Fast forward to yesterday, we're almost above 880 now in the mini, and we're down to 2167. But as far as kind of what Kip said with the commodity funds, you've to go from 3,200, you've probably lost 1,000 cars of open interest. Somebody replaced those, not all those shorts got taken out of the market. They were replaced by commercial shorts. They were replaced by commodity fund longs. Unfortunately, CFTC numbers, last report was the 24th. We are not going to get another report until we don't know when. And I like how the CFTC calls this, they use a term, where's it at here? A cyber
related.
Yeah, cyber related event. Somebody hacked the ION system. And this is where all the clearinghouses report their trades into the CFTC. So that's how the CFTC calculates the commitment of traders. All FCMs on a certain day report their aggregate net longs, net shorts into the CFTC. When you fill out that CFTC Form 40, that designates you as a commercial, as a swap trader, as a speculator, as a, it helps the CFTC categorize. So when you get that email from the CFTC asking, who you are, what you do, it's because you've pierced through 25 cars on the legacy contract. The minimum now for the mini, I think, is 6.25. So pretty much anybody and everybody that trades lumber above and beyond 1 or 2 cars is going to get an email from the CFTC to fill out a Form 40. That Form 40, I go back, is used to segment people into these different groups. The more people that fill this out, the more accurate this becomes. But right now, the CFTC, because of this cyber event, they're basically trying to validate all the information that was reported into them to make sure they're not giving out fictitious numbers. And we do not have a time frame. They have not put any updates out since the second on when they think they'll have a valid CFTC report. So to be determined. And again, if we go back to the last report, we know that this managed money component is significantly less. It could be 0. It could be sub 200, sub 300. This long component is probably greater than 500. Big unknowns here. Did commercials outside of basis trader, did the mills sell this rally? We'll find that out. And then the unreportable, again, the non-reportable position, other reportables. And just so people are aware, the managed money component of this can get a little hazy because the funds, if they own REITs or own physical land, they don't have to show up here because they can be categorized as a producer. They can be categorized as an other reportable. So just bear in mind that not all funds And I think there's a big fund that comes to mind. Don't have to show up in this area.
I think the stark difference in this Commitment of Traders report today, well, the next one we see versus what we saw 2 months ago, actually probably for the last 6 months, it's pretty remarkable. You're going to see even long short positions across all of these categories. You know, you look at the non-reportables right now, it's about as even as it gets.
Yeah.
And when I see that, I look at it and I go, huh, this is kind of a potentially directionless market. There's not much to read into it other than that it could go either way. And then you look where we are in the big picture of on the chart, we're kind of in the middle of that range, and it could go either way.
Well, you know, not only that, Mike, you know, the one thing, you know, I will say, we know that the commodity funds have gotten pushed out of this market, but you go back to, this March chart. You know, this is the second day under the 9-day now, and the last time we closed above the 9-day, the 9-day is this blue line here. It's a good short-term indicator for market movement. So the last time you closed above is when you had the breakout on the 10th of January. And this was a big catalyst to start to push the funds out of the way. So as you start to stay under this 9-day, it's not out of the realm of possibility. It's not going to be crazy if the same funds that just got short out of lumber, you know, got stopped out of their short positions in lumber, start to reestablish short positions, or other funds come in to sell this market, because the momentum has shifted back to the downside now. It's something to watch, but the funds can be highly fickle, and you might try something 2, 3, 4 times before you're proven right, and they can get stopped out and come right back in. They do it in the other markets all the time. You know, just because you get stopped out doesn't mean you have to sit in the penalty box for 30 days before you can trade that same commodity. No, that they can come right back in. If the momentum stalls and starts to go in the other direction, you could get new fund selling in lumber. And again, what you'd want to see if that's the case is a build in open interest. You know, to see that new blood is coming in, whether it's long or short, and if you're going to continue to make lower lows, lower highs, like Matt referenced here, if you start to see a build of open interest, then that's a pretty good indicator that the funds could be back in. That's what I'd be watching for. If you start to see builds in open interest on weakness, that could be new fund selling.
Yep.
That's pretty much, I did find this funny. Everything's fine. So I look at all the home builders' earnings and read through kind of, and I thought this was priceless. This literally is in Meritage Homes earnings, and somebody else pointed this out on LinkedIn, and I thought it was awesome. You know, you can kind of read through this, but they try to explain how a drop in gross margin of 31.6% to 11.6% still equals a 20% gross margin. And I thought it was interesting. You can read through this, and I missed my calling as far as being a professional financial writer here, because I don't understand it. And I guess where I'm going with this is that, how do the home builders sell more homes? It's pretty simple. You can either hope that interest rates come down, or what's the other thing you have complete power over? It's your pricing. If you're not selling homes, then you make smaller margins and you give more incentives to sell homes. And, you know, this kind of segments out geographically. You know, you can see California, Texas, Southwest, Northwest. You know, look at the percent of home builders that are throwing incentives out there to try to generate new business. This is something home builders can control. You don't have to make 30%, 25% margins. Your margins might shrink, but if you give enough incentives and you hope that interest rates come down, then that could also be the green shoot, where if you want to sell more homes, then lower your profit margin.
So, Kip, with your finger on the pulse up there in Canada, what's the breaking point for the mills? When do they really take some stuff off, as opposed to the Canfor kind of window dressing?
Well, there's a couple of things. So you are most definitely in the Pacific Northwest. You're getting mills down for 2 or 3 weeks at a time. A lot of them are private, and they don't particularly have any interest in announcing it. It's definitely happening. It's there's a little bit more to mills curtailing. They have a log deck, so they stop bringing logs in, and then they run it through the sawmill. Then they put it through the kilns, and then it goes through the planer. So it takes a while for you to actually feel less wood shipping out of the mill because you're not shipping out of the sawmill, you're not shipping out of the kiln. It has to go through the planer, and that's a process, right? It takes, can take 2 to 3 to 4 weeks. So when someone's taking curtailment, when you're going to stop seeing the wood like go on a rail car, and they have way less for sale, that can take 4 weeks. So, January curtailments, you're going to see that in March. Um, as far as like BC, the key number, and I think I talked about it before, is it's not really what the production number is in Canada. That isn't the important part. The important part is how much do we ship to the US? And if you take the last 3 months and you're comparing it to the last 3 months of last year when we had the atmospheric river and the railways got washed out and all that stuff happened, right? The last 3 months, we're down 19% to the US from Canada. It doesn't matter if it comes from Alberta, Quebec, Ontario. It makes no difference, right? It's just 2x4. So we are down substantially. Now, the other argument is going to be, well, how much is housing down? How much is the retail down? Because, the price has not really moved that much. I would say in the next 3 months, you're probably going to see somewhere around that number, 19% less. How much of that is being filled in with yellow pine? How much of that is being filled in with Euro? Definitely some, for sure. But I think you're going to see quite a bit less wood from Canada, well, obviously the last 90 days and 90 days going forward. And that's without, shutting mills down, because when they curtail a mill, it takes a while. You've got $20 million worth of logs out there. You've got employees. Like I said, you got to run it through the sawmill, kilns, planer. By the time you actually stop shipping, it's a while. Like Canfor will not be shipping from those mills in May.
Yeah.
So they announced that when? In January? So that's how long it takes to go through the system. They'll divert some logs to their other mills. They won't lose anywhere near that production. I expect you're going to see something out of West Fraser, probably Chetwynd, maybe 100 Mile House, maybe even a pulp mill, because we just simply don't have the logs. I mean, the price of lumber came down $1,000 last year, and we shipped 1.1 billion feet less to the United States, and the price came down 1,000. So this year, I think you're going to see another billion, and that's 62 billion foot market, 60 billion feet, depending on how you look at it. That's a chunk.
Does that raise the floor price?
Yes, 100%. So, I think you're going to be looking at, like, one way or another, the price of SPF is probably going to be around $500. One way or another. Not necessarily now, but over the average, the first quarter to 2 quarters could be a little dodgy, right? I mean, there's a lot of green shoots as far as housing and the home builders, but until that happens, no one's building inventory in anticipation of 1.3 million housing starts. They're just not.
Oh no,
If that happens in the second half of the year, then people will have to buy some lumber. But right now, there is no chance that anyone is adjusting their view on housing until the Fed stops.
Kip,
the
where,
simple as that.
I mean, because the fingers want to point at BC, like somehow this is only a BC problem, and yet, it's kind of seems like it's business as usual in Alberta, it's business as usual in the East, Quebec, Ontario, New Brunswick. I mean, at what point do the other mills have to take accountability, and do we? I mean, if we don't kind of realize that $500 threshold and stabilize there, do we ultimately see shutdowns? Do they have to come out of other areas of Canada? It can't just all be BC at this point.
No, no, it's not going to be. I mean, the big difference in the East is it's two parts to the business, and one part is a sawmill. The other part is the chips that go to the paper mills, the pulp mills, etc. So if you are attached to both of those, which some people are, let's just use Resolute as an example. So Resolute today is losing money on their sawmills, but they're making more on the residuals. And so there's no reason to do anything. If you're, let's call it an Interfor, I'm just using names here. An Interfor is completely sawmill. So they're more likely to take downtime because they don't get the gain on the other side. So you are going to see it from the pure sawmill guys in the East. The integrated guys, they need one to run the other. It's that simple. So,
Yeah,
and they're going
prior
to.
to
And pulp's going up in price.
Yeah.
So you're making more money on pulp than you're losing on your sawmill, guaranteed today.
And that's the, like prior to 2018, prior to the explosion here in 2020, 21, 22, that was the business model with the integrated guys out east anyway, where pulp was the star, lumber was relegated to the back of the room, and that's kind of the model they're used to anyway, historically.
I used to talk to a buddy that worked at EB Eddie, and he said, we are a chip production facility that makes some lumber on the side. And he wasn't kidding.
Yeah.
All right. Did you want to say something about this slide?
No, I just think the other thing, and again, the Fed wants to talk about deflation, having inflation under control. This is your M2 money supply. So here's your start of the pandemic. How much of this money was pumped into the economy unnecessarily? And now that it's out here, money has to go somewhere. So don't assume that the Fed is going to kowtow and be politicized anymore, because they have a lot of money in circulation in the form of debt, in the form of whatever the stimulus they pumped into the economy that's got to be dealt with. And rates, you think about all the debt that's been created as a result of the pandemic at record low interest rates. Debt always resets at fair market value. So bear that in mind, that there's a lot of money out there that the Fed has to absorb to kind of even get remotely back to, okay, if you want to say that, where do we belong? You're substantially higher than the trend line would support. So there's a lot of heavy lifting, in my opinion anyway. This speaks volumes. There's a lot of heavy lifting left to be done by the Fed.
I mean, right there, it just shows you that's a steady line prior to the pandemic, and it took a serious jump. I mean, if you extend that steady line out, we've got quite a bit of money to take out.
And from an emission standpoint, a lot of the inflation that was created was the direct result of firing a bazooka. And look, the first, I get it, but bazooka number 2, bazooka number 3, were they necessary? It doesn't matter now. The money's out there, it's circulating. So, you've got to rein this back in, and that's easier said than done. But no, other than that, it's awesome having Kip here. It's nice to hear somebody else's voice. So Kip, as far as I'm concerned, you're welcome anytime. Love to have you as a regular if you're available.
Yeah, no, I appreciate it.
All right, everyone.
Thanks, guys.
We've successfully burned through 51 minutes. Greg, thanks for bringing that great information out. I think there's times in the market where we're trending and everything, just makes sense, and you buy it and you got a winner. While it's important, of course, to be paying attention to the data at those times, it's really important when the market is choppy sideways to try to find whatever nugget of gold is going to make a difference in your business and in your decisions regarding lumber. So with that being said, tune in next week. Let's see what happens over the course of these next days. We'll get a good, I hope, knock on wood, we're going to get to see the CFTC report this Friday. I think that's more telltale than anything. At least it has been for the last 6 months for sure.
Absolutely.
All right, everyone. Have a great week, and we'll talk to you next week, Tuesday.
Thanks, guys.
Thanks, guys.
It was good